Hello students of class 12. Today we will talk about government budget. It's a chapter, important chapter of macroeconomics, government budget. We are all aware about the term budget. It is not a new term to us. I know you all know what is actually meant by budget. Because in every family, for the proper management of their financial condition, a pre-planned activity is required. Even in a family, people try to match their expenditure with their income. They always calculate what is their income and what should be their expenditure. Similarly, when we are talking about the budget of an entire economy, of a government, of an entire country, same is the concept. Government budget is a financial statement regarding different sources of its income and proposed expenditure in different heads for the coming year, for the coming financial year. So in short, it is a statement about government income and expenditure. Now when government prepares a budget, when it is being prepared, always it is composed of two parts. One is called revenue budget and the other is called capital budget. So every budget is composed of two parts. Its revenue account and its capital account. When we talk about revenue budget, this budget should have a statement about its receipts and also about its expenditure. So revenue budget is again classified into two: revenue receipts and revenue expenditure. Similarly, when we are talking about this part of the budget, capital account, capital budget, this capital budget must have two parts: one for capital receipts, another for capital expenditure. Now the important thing is, how will we classify the receipts into revenue receipts and capital receipts, and how will we classify the expenditures into revenue expenditure and capital expenditure. We will start with an example. Tax receipts. Tax receipts are included within the head of revenue receipts. It is not a capital receipt. It is included in revenue receipt. Now consider another example. Under the head of capital receipts, we are including these investments or borrowings. What is the basis of classification? These investment means selling of shares. When government earns by selling its shares, that means these income generates, but its financial asset is declining. Selling its share means financial assets are declining. And government income may generate by borrowings. It is also included in the head of capital receipts. Borrowing. When government borrows from central bank or World Bank or any other financial institution, it is obligatory to pay it back. So borrowing is always a liability for the government. So receipts, where either asset declines in time of disinvestment, selling of shares, asset declines, or where liability increases in time of borrowing, liability increases, we include them in capital receipts. But in case of tax receipts, asset liability condition is not affected. Government income through taxes is not increasing its liability, also it is not reducing its assets. So asset is not affected, liability is not affected, so it is within the head of revenue receipts. This is the principle of classification. So I repeat, in time of capital receipts, we will consider whether liability is increasing due to this receipts or asset is declining. If any one of them is happening, then capital receipts. But if asset liability condition is not at all affected, then it is revenue receipt. Similarly, some expenditures will be included in revenue expenditure, some will be in capital expenditure. See the example. For revenue expenditure, we are considering expenditure on salary of government employees. Government is regularly paying salary to the government staff. This expenditure is not affecting asset liability condition of the government. But consider this expenditure, purchasing of shares. Government is spending money to purchase shares of different companies. So when government is purchasing shares, his asset is increasing. It is such an expenditure for which asset is increasing. Or if government is spending money for the repayment of loan, this expenditure, when repayment of loan is going on, it is reducing government's liability. So any expenditure where either asset increases or liability declines will be under the head of capital expenditure, included in capital expenditure. But if any expenditure which is not causing any increase in asset or any reduction in liability, that will be included in revenue expenditure. Now take some other example. Suppose profit earned by government enterprises. So is government receipt? Government companies are earning their profit, but that asset liability condition is not affected. So it will not be a capital receipt, it will be a revenue receipt. Now suppose, consider one type of expenditure, government expenditure for the construction of a school building. This expenditure is generating a physical asset. A school building is considered as an important physical asset. So when this expenditure is increasing asset of the government, surely it will be capital expenditure. It will not be a revenue expenditure. So in this way, you may be asked, you will be given some items and you will be asked which one is revenue expenditure and which one is capital expenditure. In time of revenue receipt, classification in between revenue receipt and capital receipt, what will you consider? You will consider whether this receipt is increasing liability or reducing the asset. If any one of them is happening, capital receipt. If nothing is happening, revenue receipt. An opposite thing happens in case of expenditure, capital expenditure or revenue expenditure. If any expenditure is increasing asset or reducing liability, capital expenditure. If asset liability condition is not affected, neither increasing the asset nor reducing the liability, then it will be included in revenue expenditure. This is the idea about preparation of budget and classifying items into revenue account and capital account. This much today. Thank you all.